Welcome everyone. Today we're diving into the world of real estate investment trusts or REITs and exchange-traded funds or ETFs. Let's start with REITs. Imagine owning a slice of a high-rise office building or a sprawling shopping complex without having to buy the entire property. That's the magic of real estate investment trusts. REITs are companies that own, operate, or finance income-producing real estate. They allow individuals to invest in portfolios of large-scale properties the same way they invest in other industries, through the purchase of stock. The beauty of REITs is that they are required by law to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This makes them an attractive option for income-focused investors. On the other hand, we have exchange-traded funds, commonly known as ETFs. Now picture a basket. This basket doesn't hold fruits or vegetables, but different types of investments like stocks, bonds, or even REITs. That's an ETF for you. ETFs are investment funds traded on stock exchanges, much like individual stocks. They aim to track the performance of a specific index, sector, commodity, or asset class. Investors might choose ETFs for their diversification benefits, as they spread risk across a wide array of securities. Plus, they offer the flexibility to be bought and sold throughout the trading day, just like individual stocks. So in essence, we have REITs that offer a doorway into real estate investment, providing regular income and potential capital appreciation. And then we have ETFs, a kind of investment basket, offering diversification and trading flexibility. Now that we've laid the groundwork, let's delve deeper into the benefits of investing in individual REIT stocks versus REIT ETFs. Enjoying this content? Don't miss out on future videos filled with even more tips, tricks, and inspiration. Hit that subscribe button now to stay tuned with us. Individual REIT stocks provide several unique benefits to investors. Let's explore them. When it comes to real estate investment trusts or REITs, one of the primary advantages is the ability to handpick your investments. By investing in individual REIT stocks, you can focus on specific sectors that you believe have strong growth potential. Maybe you're bullish on the industrial real estate market, or perhaps you see potential in the residential sector. Whatever your preference, individual REIT stocks give you the freedom to follow your instincts and invest in the sectors you believe in most. Speaking of freedom, let's talk about control. When you invest in individual REIT stocks, you have direct control over your investment. You decide when to buy, when to sell, and how much to invest. This level of control can be empowering, giving you the ability to actively manage your portfolio and make decisions based on your own research and analysis. Now let's move on to returns. While it's true that all investments come with a level of risk, individual REIT stocks can potentially offer higher returns compared to REIT ETFs. This is because when you invest in a specific REIT stock, you stand to gain more if that particular REIT performs well. Of course, the opposite is also true. If the REIT performs poorly, your losses could be greater. But for those willing to take on a bit more risk in exchange for the potential of higher returns, individual REIT stocks can be an attractive option. Additionally, individual REIT stocks can provide investors with a more direct connection to their investment. When you invest in an individual REIT, you're investing in a specific company with its own management team, strategy, and portfolio of properties. This can provide a level of transparency that can be reassuring, especially for those who like to know exactly where their money is going. Lastly, let's not forget about dividends. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This can provide a steady stream of income for investors, which can be especially attractive for those looking for income-generating investments. So, to recap, investing in individual REIT stocks provides the freedom to choose specific sectors, the control to manage your own investments, the potential for higher returns, a direct connection to your investment, and a steady stream of income through dividends. But as with any investment, it's important to do your homework. Research each REIT thoroughly, understand the risks, and make sure it aligns with your overall investment strategy. As you can see, individual REIT stocks can offer a high level of control and potentially higher returns, but what about REIT ETFs? REIT ETFs also have their own set of benefits. Let's delve into them. First up, let's talk about diversification. When you invest in a REIT ETF, you're not just putting your money into one or two properties, Instead, you're investing in a basket of various real estate assets, which can range from commercial properties to residential buildings, and more. This spreads your risk across multiple properties and sectors within the real estate industry. So if one sector takes a hit, your entire investment isn't at risk. That takes us to the next point, lower risk. Because you're not putting all your eggs in one basket, you're inherently lowering your risk. If we take a moment to think about it, investing in a single REIT stock can be quite a gamble. If that specific REIT or its sector underperforms, your investment could take a significant hit. But with a REIT ETF, you're not tied to the performance of a single REIT or a specific sector. Your investment is spread across multiple REITs and sectors, providing a cushion against any single underperforming asset. Now let's touch on the ease of investing. REIT ETFs are traded on major stock exchanges just like individual stocks. This means that you can buy and sell shares of a REIT ETF with the same ease as you would any other stock. Plus, you don't have to worry about researching and hand-picking individual REITs. Instead, you're entrusting your money to fund managers who have the expertise and resources to analyze and select a diverse range of solid REITs. This can save you a lot of time and effort, especially if you're new to the world of real estate investing. Another benefit worth noting is access to global real estate markets. Some REIT ETFs invest in international REITs, giving you exposure to real estate markets around the world. This can be a great way to diversify your portfolio geographically and potentially tap into growth in emerging markets. Lastly, let's not forget about the potential for steady income. Just like individual REITs, REIT ETFs are required to distribute at least 90% of their taxable income to shareholders as dividends. This means that as an investor you can look forward to regular income payouts, which can be particularly appealing if you're investing for income or planning for retirement. In conclusion, REIT ETFs can offer a good balance of diversification, lower risk, and ease of investing, with the added bonus of potential access to global markets and steady income. They can be an attractive option for both novice and experienced investors seeking to include real estate in their portfolio without the hassle of owning and managing properties. So, REIT ETFs can offer a lower risk, diversified investment strategy. But how do you decide between the two? Choosing between individual REIT stocks and REIT ETFs depends largely on your investment goals and risk tolerance. So let's dive deeper into the comparison to help you make an informed decision. When you invest in individual REIT stocks, you're essentially choosing to buy shares in a single company that owns and manages real estate. The main advantage of this approach is the potential for higher returns, as successful REITs can significantly outperform the market. Moreover, you have complete control over which companies to invest in, allowing you to handpick those with the best prospects or those that align with your values. However, this approach also comes with its challenges. Firstly, investing in individual REIT stocks requires a considerable amount of research and market knowledge. You need to assess the company's financial health, the quality of its properties, and its management team, among other factors. Secondly, it comes with a higher risk, as your investment's performance is tied to the success of a single company. If that company underperforms, your investment could suffer. On the other hand, REIT ETFs offer a different kind of investment experience. These are funds that invest in a diversified portfolio of REIT stocks, spreading the risk across multiple companies. This is a fantastic option for those who want exposure to the real estate market without putting all their eggs in one basket. The main advantage of REIT ETFs is their inherent diversification. By spreading your investment across multiple companies, you can mitigate the risk associated with any single company's failure. Additionally, REIT ETFs require less research and market knowledge than individual stocks, as the fund manager takes care of the asset selection and management. However, this advantage can also be a disadvantage depending on your perspective. While you'll be safer from the failure of any single REIT, you'll also be less likely to reap the benefits if one company significantly outperforms. Moreover, REIT ETFs come with management fees, which can eat into your returns over time. So, how do you decide between the two? The answer lies in your investment goals and risk tolerance. If you're willing to take on more risk for potentially higher returns and have the time and knowledge to research individual companies, investing in REIT stocks might be your best bet. But if you prefer a more hands-off approach and are comfortable with moderate returns, REIT ETFs could be a better option. It's also worth mentioning that you don't have to choose one or the other. Many investors opt for a mixed approach, investing a portion of their portfolio in individual REIT stocks and another portion in REIT ETFs. This strategy allows you to benefit from the potential high returns of individual stocks while also enjoying the safety of diversification offered by ETFs. Ultimately, the choice between REIT stocks and REIT ETFs comes down to your investment strategy and goals. So consider your options carefully and make the choice that aligns with your financial objectives. We've covered a lot of ground today, from the basics of REITs and ETFs to the benefits and drawbacks of each. Let's take a moment to revisit the key insights we've gleaned from our discussion. We started by familiarizing ourselves with real estate investment trusts or REITs and exchange-traded funds or ETFs. We discovered that these investment vehicles offer unique opportunities to diversify our portfolios and gain exposure to real estate markets. We then delved into the advantages of investing in individual REIT stocks. The potential for high dividend yields, the ability to select specific sectors or properties, and the enticing prospect of capital appreciation are all compelling reasons to consider this option. Yet, we also acknowledge the benefits of REIT ETFs. The built-in diversification, the lower risk associated with spreading investments across numerous REITs, and the convenience of buying and selling like a regular stock are all attractive features of this approach. In comparing these two paths, we realize that there is no one-size-fits-all solution. The best choice depends on your personal investment goals, risk tolerance, and the level of involvement you desire in managing your investments. For those of you who are more risk-averse and prefer a hands-off approach, REIT ETFs may be the better choice. But for those who don't mind a bit of risk and enjoy having a say in their investments, individual REIT stocks might be just the ticket. In the end, both REIT stocks and REIT ETFs can be valuable additions to your investment portfolio. They offer different routes to the same destination: the opportunity to participate in the real estate market without the need to own physical property. Before we wrap up, if you found this video helpful and want to stay informed about more topics like this, don't forget to subscribe to our channel. Until next time, happy investing!